welcome everybody to Conversations with Curio. As always, I'm joined by my colleague here, Mr. Jake Sadler, and today our discussion is going to be around the top tax strategies investors should consider when implementing a portfolio, taking money out, all that good stuff. So it's tax season, and we're dealing with taxes right now, but this really doesn't relate to like tax savings opportunities necessarily, like deductions and income deferral and that sort of thing.
That's an interesting point. And as a CPA, you've been in tax for a long time. Like, how do you look at tax? Do you like look at it just at a year-to-year basis, or are you also thinking about kind of total lifetime tax? Like, can you calculate that, like total lifetime tax bill?
Yeah, it is that's how I think about it.
Yeah.
I don't want to say how other people think about it, but I think in the tax world, we're so reactive. A lot of times just trying to prep tax work because we're in this sort of shortened period of deferral. It's really fun to come at it from a financial planning perspective when that burden doesn't weigh on you so much, because you can start to think about like what you're going to pay in the future and some of the decisions you're going to make now, how important they are to determine what you might pay in the future. So it's a really good question. What was the term you used right before we got started? You were talking about in terms of an investment portfolio.
Oh, well, yeah. I mean, I think it's one of the strategies. I mean, we're talking about total return investing.
Total return investing. That's it.
I mean, like, there's like not like that is such a total jargon like phrase. I think it needs to be unpacked a little bit, but total return investing sounds like something it's been branded and advertised. But you want to talk about it?
Yeah, let's talk about it. I mean, to me, total return investing there's essentially four ways that I think about tax planning and integrating taxes with total return investing. The first one is like, I'm going to make up a name right now, accumulation location. And
okay.
where do you put your money when you're saving it? And then the second one is like tax loss gain harvesting is one of the other one. Number three, and these are in no specific order, would be asset location, where you hold your money. And then the final one that I think about is withdrawal planning, both in retirement and we could tack onto that one like estate planning piece of it.
Yeah. So like that's, so you got like, it was no specific order, but that was pretty good order. Like you're talking about, if we were talking about total return investing and really thinking about managing a portfolio for a lifetime and thinking about the total lifetime tax bill, not just being reactive and like, oh, what happened last year? What kind of taxes do I owe? But thinking about it from 30,000 feet and like where to put it in, what to do along the way, what types of investments go where, and how to take it out. All those from a tax perspective.
You got it. Let's start with where to put it, since you're young and you're saving money, and it's really important to figure out like where to put it. What do you think about when you're helping people figure out where to put their money in terms of from a tax perspective?
Yeah, I mean, I like to think about this first as like a tool belt. Like everybody's got different kind of configuration on their tool belt, and when you're thinking about where you can save for retirement or where you can save to invest, the set of options that you might have might be different than the set of options somebody else has. A lot of that has to do with the tax advantage accounts, workplace retirement plans specifically, that you might have access to, but also with retirement accounts, what you may be eligible for just based on your overall income and tax picture. So I kind of start by saying, okay, what's on your tool belt? What are the account types that you are either eligible for or have access to? And everybody always has something on their tool belt. I think that's important. There is no one out there that just has no options. So everybody has options. So then once you kind of see what's on your tool belt, and what your options are. Then you can look at the tax pros and cons of the different types of accounts that you have. I think a good example, where to start is like a traditional IRA, individual retirement account, versus a Roth IRA. So,
right. So I'm an individual investor. I got a regular job and I get a W-2. My wife gets a W-2. What types of things are on my tool belt in terms of figuring out where to put money? You just mentioned two of them, an individual, an IRA, a Roth IRA. Yep. What else do we look at?
Yeah, IRA and or Roth IRA. What do you have access to through your workplace? You have a 401k. There are a number of different types of, retirement accounts that you might find through your workplace. So find out what you have available first. And then, of course, you have a taxable account. So
just real quick,
tax investment account.
Let's get specific on that. So I go into my employer, I start a new job. What am I looking for?
Yeah, so the common account types that you'll find through the workplace, 401k, that's kind of the tried and true. Everybody's mostly heard of that. 403b, it's basically a 401k but for nonprofits.
Jake, you're going a little fast for me. Pretend I know nothing. What's a 401k do for you?
Okay, all right. So 401k is a workplace retirement plan sponsored by your employer, and that allows you to, if nothing else, put away money pre-tax. So put away money that's not getting taxed in the year that you save it. Yeah. And set it aside. And you can invest those dollars. Your 401k plan will almost always have a menu of investment choices for you to choose from. As your investments grow, as your savings grow within the plan, you don't pay taxes along the way. And that's another really important advantage.
So that initial contribution I make, again, pretend I know nothing. How does that help me like in today? What does that do for me?
Yeah, so you get the current year tax benefit. So if you're putting away pre-tax in the 401k, say you've got a base salary, just easy numbers, 100K, and you're putting 10% of your salary in to the 401k, it's 10 grand. So basically you're only paying income tax on 90 grand.
Right. So I'm saving $10,000, but it only affects my cash flow maybe by $7,000 because I get that I have a reduced amount of tax I'm paying.
Yeah, exactly. So you're not paying tax on that, the 10% of your income that you're putting in there.
Yeah.
And so in a current year, you get that tax benefit. So you're reducing your taxable income.
Right. And if you do that, a lot of times there is opportunities. The employers will most likely match your contribution that they're putting in or give you an additional contribution. So what, if you're using a 401k, what's the other option that most employers allow nowadays?
So nowadays you'll typically have the option between pre-tax contributions to your 401k and Roth contributions to your 401k. And that's a little bit different. So same example, you've got base salary of 100K and you're saving 10%. We'll forget about the match for a minute. In the pre-tax example, you put 10,000 in. Now your taxable income is basically only 90,000. In the Roth, you don't get the current year tax benefit. So you actually go ahead and you pay the tax on the money that you put in to the Roth portion. But then a beautiful thing happens. It's tax-free forever after that.
That's right.
So, with the pre-tax and the Roth, it's tax deferred. So you're growing your account over time. Your investments go up in value, hopefully, and you're not paying tax along the way. In retirement, we kind of get to that other end of the tax, strategies. When you start taking money out of your accounts, if you've saved in those pre-tax accounts, when you take money out, that's taxable income.
Right.
With the Roth, you pay the tax up front, you take money out, it's tax-free.
So that's a question we get a lot of times is where do I save, in the pre-tax or the Roth? How do you answer that? And I can certainly give my answer.
Yeah, obviously it is on a case-by-case basis. There's two real factors. One, it's kind of your assessment for your current tax rate versus where you think it might be in retirement.
Yeah.
But then the other important factor is age. So, if you're much closer to retirement, then to kind of justify saving into the Roth, you kind of do want to have an expectation that your tax rate's going to be the same or maybe even higher in the future. That's probably not going to be the case, though.
Yeah.
Whereas if you're younger, even if your tax rate is higher now than you think it'll be in retirement, you have this runway of time where you can grow that money. And in the end, you'll end up with more on an after-tax basis when you get to retirement.
All right. So what I just heard was that if you're typically is when you're younger, it's better to save in a Roth because most likely you're in a lower tax bracket because you're in your sort of initial years of earning, and then you're going to hopefully accumulate a ton of money and you'll pull it out tax-free. And then really when you get towards this retirement age or you're closer to retirement, you're most likely making a lot more money. So you get a bigger tax deduction because you're in a higher tax rate. And then maybe you pull it out, at a lower tax rate in the future. So there's this age thing, which applies to sort of the way I think about it is, it's younger because you're most likely earning less money. And you want to make sure that you have a lower tax bracket if you're using that Roth piece. But it is a guess. Yeah. You don't know.
It is a guess. And I think it is important, when you kind of look, say you're younger, I mean, your tax rate, you might be young, you might be earning a really good income. Your tax rate might actually be higher than what it ends up actually being in retirement. But because you have decades to grow that money, the element of time and the kind of magic of compounding ends up putting you in a lot of times a potentially better situation. You end up with potentially more on an after-tax basis in retirement, even if your tax bracket in the future is lower.
We might have to run a math on that.
Yeah, you do have to run the math. So it's important to run some numbers. And I think the more time you have, the more likely it is that's the scenario. But also, the more uncertainty there is about, ask a 30-year-old what their tax rate is going to be when they're 60. I mean, guess this is good.
You have no idea. So, and that's a great place to start with the retirement plans. There's really no income limits that you need to worry about when you're contributing to these plans. When you get down to the IRA and the Roth IRA, which you mentioned earlier, there's typically income limits on those contributions, and they start to apply if you're contributing to a 401k or 403b or Roth or whatever vehicle. And so those income limits apply. And most of the times you're limited in terms of what you can contribute to the IRA or Roth IRA. So I would most likely start by contributing to your company retirement plan because there's no income limits and the amounts you can contribute are much higher. It's $22,500 for an individual to contribute to a company 401k. And what is it, $7,500 now for IRA or Roth IRA. So, and those get limited a lot of times. Any other vehicles that you can think about in the accumulation? You mentioned a brokerage account, just a regular brokerage account.
Yeah. So, I think that's an important one to mention where that's going to be an option that everyone has. There's no limitation. You don't have, it's not tied to your workplace. It's not, your eligibility to contribute isn't based on your income. So, that's a vehicle that's going to be available to anyone where you can save and invest. And with the brokerage account, that also has a different tax treatment, and it's kind of pay as you go. So we're talking about the retirement accounts where you get this tax deferral and maybe a current year tax benefit or maybe a benefit in retirement. But with the brokerage account, you're paying along the way. So as your investments go up and as they pay you income, dividends, and distributions, then it's creating taxable income for you in the year that you receive it.
Yeah, and what we failed to mention in terms of those 401ks, when you put the money in there and in the IRAs and Roth IRAs, you're really not allowed to take those out until you're 59 and a half. And if you do, then you'll have some penalties. And so you got to make sure that when you're saving that money, it's for the longer term. And this brokerage account you're describing is a way to access that money sort of if you need it prior to your actual retirement age.
Yeah, it's so hard to, kind of walk through, the different types of accounts without touching on these different caveats to participation and the rules for each and that sort of thing. They're all really important, but they all kind of define, like, I think just to back to that starting point, as you look to tax strategies for accumulating, what's on your tool belt, what fits for your situation, and what's going to make sense for your different objectives. So like you said, those penalties, those rules are really important. If you're saving in retirement accounts and you think you might need some of what you're saving in 5 or 10 years and you're still under 59 and a half, maybe you want to save some money in a brokerage account instead, so that you can access it.
I love thinking about it in terms of buckets, and that gets advantageous, and which we'll talk about in a second, is when you have money in different places, when you go to pull your funds out, you have a lot more flexibility in terms of the tax you're paying. As always, Jake, we belabored the point. We went on for probably way too long on that one topic, and so now we're talking
money. We set the stage, though. We set the stage for all the other ones. So
yeah, we can blow through the other ones. So asset location, let's talk about that one. That's what we think about a lot in terms of managing portfolios. We could probably run through this one pretty quick.
Yeah, I think this one, you can kind of summarize this as putting the right types of investments in the right types of accounts. And right is defined by the tax treatment. So, and, on the account side, and right is defined by kind of risk and return relationship on the investment side. So the kind of cliche one that we talk about, what is that one, Jim? I'm going to throw it back to you.
Yeah, you hold your fixed income or your investments that pay off ordinary income on a regular basis in your tax deferred accounts. And then you would hold your equities or your stocks that grow, and you don't really pay tax on those until you sell them, and they're taxed at capital gains rates. So that's the way I think about it in terms of holding assets in different locations. And then the other one would be the Roth IRA, because it gets that tax-free growth. You want to probably have a more aggressive allocation to that account so that it grows as much as possible. Doesn't always work out, can certainly go down, but you want to get your growth there.
So do you want to hold different types of investments just because you have different types of accounts? Like, if all you have is a 401k, is fixed income the only thing you want in there?
No. You use your tool belt. You got to be careful. You need returns, so if you're younger, you don't want to have all of your fixed income in a taxable account just because it's tax deferred and not going to spin off any income. You need some growth on that. And the way you get growth is you hold it in the equity. So, if just because you have one doesn't mean you necessarily change your investment allocation, but we think about it as like a global asset allocation where, if you look at a portfolio and then you divide it between, the different accounts you have, it might be ideal to have, equities in a taxable account and, fixed income in a Roth, but there's all kinds of reasons why you might have variations around that. So that's just general sense of the way we apply it. And then we factor in the other aspects of your life. Like, do you need the money? Risk tolerant, what age are you? All that good stuff.
So you're kind of thinking about, from the investment side of things, putting the right kind of investments in the right kind of accounts. It depends on, what you have, first of all, what do you want to build? Second of all, what's in your tool belt? So what do you want to build is kind of that, if I'm hearing you right, that's the asset allocation piece. That's figuring out the situation. What kind of return do you need to kind of get where you want to go?
Yes.
With the corresponding kind of appropriate amount of risk. And then you say, okay, I need that. Now what's in my tool belt? Where can I best put the different investments that I need to build the portfolio I want?
You got it. Yeah. That's exactly the way I would describe it. Yeah. And it's not a perfect science, but there's, you should definitely consider it. Sometimes people come to us with portfolios and they have all their equities, they're 50-50 and they have all their equities in, retirement account and their fixed income in a non-retirement account. They're over 59 and a half. And, they could be saving just annual tax potentially of 10% on their returns. And that really adds up over time.
Mm-hmm. I think that's a really good point too. I mean, it's not a perfect science. It's okay to be approximately right. It's really optimizing your situation for what the tools that you have available.
Yeah. My head's starting to spiral a little bit because, once you get into this 62 to 73 age range. You have like things to consider like Medicare and health insurance and all that good stuff, and your income that shows up on your tax return affect all that. And so you got to be careful. Like, you don't want to generate too much income. You might create tax on other streams of income, like Social Security, or your Medicare premium might go up to a higher level. And so there's all kinds of factors in that once you retire age group.
Yeah, I love calling them tax torpedoes.
Tax torpedoes, yeah.
Tax torpedoes. So, let's kind of shift to the next one. So we talked about kind of accumulation. So we're kind of, what do you have available, where to put the money, and then kind of you need to identify, okay, what kind of investments do you need for your situation, and what's in your tool belt, where can you put those investments, and let's talk about kind of what we're doing along the way. I think it's pretty simple when we're talking about pre-tax accounts or Roth accounts. Are we doing anything with those? Are we dealing with tax along the way with those types of accounts?
Really along the way, it's, where you're saving money, it's where you're holding money. And then there's a few things that we look on a regular basis. And we call it tax loss harvesting or tax gain harvesting. And that really means taking advantage of whether a security or investment that's held in a taxable account has either declined in value or appreciated in value. And so the rules are that if you have a stock that you purchased and it goes down in value, and let's say you purchased it for $10,000 and it goes down to $7,000 and you liquidate it, you can then take that loss on your tax return to offset other potential capital gains that you might incur from selling other stocks or other investments. Mm-hmm. And also, if you don't have that to offset it, then you could just take a $3,000 loss against ordinary income on a regular basis. So there's tax loss harvesting, and then there's tax gain harvesting, which, back in the day we really never thought about, but there's this rule where if your taxable income is in the 12% tax bracket and you have capital gains within that amount, they're taxed at 0%. So you don't pay any tax on the capital gains if your taxable income is within that 12% tax bracket for an individual person or a joint filer. So sometimes there's opportunities, like when people retire, to liquidate a position in a stock and pay 0% tax because they have no other income. Their salaries are gone. They've delayed taking Social Security, and they're using money in an after-tax account like cash to fund their living expenses. That's the next topic.
Mm-hmm. That is the next topic. And but before we get there, on the capital gains that we're talking about, kind of gains harvesting, losses, if you're harvesting those, you can stack those up and use them to offset gains. Is there a difference, or what is the difference between the capital gains tax rates and tax rates for, income, just regular ordinary income? Not numbers necessarily, but like, is one higher, is one lower?
Yeah. So most definitely the capital gains tax rate is lower than the ordinary income tax rate. And so the capital gain tax rate applies to assets or investments that you sell in a current year, and ordinary income applies to, wages, interest and dividends that are non-qualified, and, other things that are not asset sale related, I'll say.
Mm-hmm.
It's typically
right for ordinary income.
Yes, correct.
Yeah, and you have to hold on to your investments for a period of time, right, to be able to get that lower tax rate treatment.
You got it. So yeah, you got to hold on to your assets for over a year before you sell them, and you will get the long-term capital gains tax. And if you don't hold on to them a year and you sell them, then that's short-term capital gains, which is ordinary income. So it really makes sense, unless you have some crazy gain that you want to liquidate and you're scared of a stock or something going down. Most likely you want to hold something for 12 months so you can get that treatment, which automatically saves you money and increases that total portfolio return that you have.
Yeah, that's kind of what it's coming back to, I think, which, like, is you're describing that you got to hold on to these investments for a year to get this lower tax rate treatment, which sounds pretty great. But you got to hold on to it for a year. So I think it kind of naturally leads to kind of fit within that total return approach, and a focus on capital gains, lower tax rate treatment, which means lower, less trading, lower turnover in the portfolio, and really kind of taking a few steps back and being intentional about the tax consequences of what you're doing in your portfolio.
Yeah, there's no doubt. Like most people talk about returns and they talk about the S&P and they talk about what their investment did, but taxes do have an impact. They're hard to quantify what you're saving on a regular basis, but they have an impact on your total wealth or your total growth of your portfolio.
Yeah. And I know taking money out, you can't just take money out willy-nilly from different accounts that you have. So, what are we looking at when we're thinking about, using the portfolio, say in retirement, starting to take withdrawals out? What are we looking to, each year as we're planning ahead to be mindful of taxes?
Did you switch this around on me and start asking me the questions?
I think, as the CPA in the room, you might be better qualified.
It's a lot of pressure. I was trying to get you to answer all the questions. But yeah, so withdrawal strategies, it's really fun, actually, if I can say that word, in terms of finances for us, like thinking about this puzzle that you have to put together. And it's on my list to actually do a tax projection and illustrate the savings that you can have by where you pull money from. I got that's on my list to just to update it, because where you pull your money from, as we described early in this conversation, has an impact not only the amount of tax, but the tax rate that you're paying. And depending on the income that your investments or your sales or whatever happens and goes on your tax return could affect other things, like your tax torpedoes that we talked about. You could pay 0% of tax on your Social Security if you have no other income, but once you get to a certain level of income, you start paying tax on that Social Security. And things that are factored into that are, capital gains, other income, retirement withdrawals, all that good stuff. So you have to be really careful. There's, the early years, if you have to rely on the health exchange prior to retirement, there's potential for tax credits if your income's low enough. 465 when you're on Medicare. And then the last one that I have, Jake, is the Medicare premium.
Yep. The income-related Medicare adjustments.
Yeah. So let's flip that back to you. And that means what?
Yeah. So it's one of those tax torpedoes that we talk about. So, when you're in retirement, you're over 65 and you are eligible for Medicare. Part A, now we're getting into Medicare. Part A is, typically free for most people, almost all people. But Part B, this other part of Medicare, that has a premium attached to it. And that premium is deducted usually from your Social Security income. Depending on your prior year's tax return, basically how much income you had, that premium can change. And so if you have a big income year in retirement, say you had a second home, this is kind of a common example. You had a second home and, you decide, I'm not really using it, and you sell that and you have a big income year, you're in retirement. Well, then all of a sudden, you file that return, and then the following year after that, you see your Social Security income coming. You're like, why am I getting so much less? And you take a look at your Medicare premiums, and they've skyrocketed. So basically, you get penalized. It's kind of like a surtax almost, where your Medicare premiums go up depending on where your income is. Yeah. And that can be kind of a gotcha.
Yeah. And sometimes there's no way around it, but if you can keep those lower, again, it save $100 a month, it's $1,200. It goes into your total return of your portfolio.
So we're kind of we that's a good example of trying to kind of read the tea leaves, if you will, of your tax situation, being proactive and planning, thinking about where your income's going to end up and what are some of the consequences of taking money from here or there. Oh, it might phase in Social Security, might hit the Medicare premium surtax. How are you, what tools do you need to be able to read these tea leaves on the tax side of things? How can you gain insight into this? Do you just have to know the rules, or you have some tools? What do you do?
Well, we certainly have tools because it's really hard to evaluate. But you number one, you need to know the rules, and then you need to have some sort of I guess planning software to see the impact of these changes or income. You can sort of estimate it in a lot of cases, and with the softwares that are available now, you could probably figure it out pretty easily. But yeah, it's a puzzle, like I said. So sometimes it takes multiple tools. Like, for example, we get like estimates from our investment provider about like how much dividends are going to be paid out in December. And so we can take that and then we can coordinate it with incomes and run a tax projection and see if we need to, recognize losses or whatever the case may be. So it takes a little bit of work to do it, and you definitely could utilize some tools.
So you need the tool, you need some knowledge, and you need some tools, and you have to be thinking about the puzzle. Like, as you think about, you said you're having fun doing it, like putting together the retirement income puzzle, like how far ahead, like, are you looking? Are you kind of looking at, where income's going to be in 5 years? Or are you kind of on a 2-year cycle, or how are you doing that in terms of time frame?
I think you got to look at it at every different way. Like, and what I mean by that is, like, if you have a young person that is aggressively saving money and is well on track to accumulate a lot of money in a retirement account, you need to look out in the future and see what the tax impact of that accumulation might be at an ordinary income tax, because we're going to get in the weeds here, but you're required to start taking that out at periods of time. And then if you pass it on to future generations, you got to take it out within 10 years. And so there's an impact that you got to start to think about at a pretty early age. And that's why we talk about that accumulation location. It's important to think about in those different places. And then just on a regular basis, thinking about things like, should I convert a Roth? Should I pull income from a taxable account? All that stuff. So you do have to think about it on an annual basis. The one thing I would advise against is, waiting till the year end. After the year end, because once the year closes, you lose the opportunity to make some of these decisions, and you're stuck with what you did in the previous year. So I would say you got to look at it across the board. It's really hard to predict in the future, but you need to start thinking about it on an early age for each one of these phases we talked about.
So one last point, because that you said it's really hard to predict, maybe even impossible. I mean, is it even useful to try and predict? I don't know, but as you think about, the uncertain nature of, where tax rates are going to be in the future, what investments are going to do, that sort of thing, like, does it pay off to diversify kind of your tax mix? Like, is tax diversification something that is worthwhile? Like, have a little bit in pre-tax, have a little bit in Roth, have some brokerage. Like, how does that pay off, when you start taking money out?
Yeah, I love diversification. What do you say? It's the only free lunch. And so that's not your quote, that somebody else's, but yeah. So the different asset locations you have, the more flexibility you have in the future, the more opportunity you have to take advantage of some of these tax savings.
Yeah, I love it. Flexibility,
my man. All right, Jake. Well, great conversation as always. I never think we're going to go 5 minutes and we go over a half hour, and so. Thank you all for joining us and listening. Hopefully you've learned something. If you ever have any topics you want to share, feel free to do so. And don't hesitate to, I'm going to be a YouTuber right now, so give us a like or something like that on our videos.
I like the ideas. Float some ideas out there if you got some for topics. So
have a great day.
Thanks, everybody.